Good morning. Today is Monday, May 5th, and this is Jeffrey Hedley, Managing Director of Robert W. Baird and the Hedley Hoeger Group. For the month of April, we continue to see significant volatility in the markets, although we did see most major indices post positive returns for the month. Our market scorecard for the month includes the S&P 500 was down 0.8 for the month and is now down 3.3% for the year. The NASDAQ 100 was up 1.75% for the month and is now down 4.24% for the year. The Russell 1000 value was up 2.06 for the month and is now down 0.20% for the year. And the Europe, Australia, and Far East Index was up 4.58% for the month and is now up 12.57% for the year. Trade and policy uncertainties continue to reign supreme in the U.S. and have led to the volatility we have seen so far this year in our markets and abroad. With this, though, U.S. companies on average were able to post a blended growth rate of 12.80% for the first quarter, which beat most expectations. One thing we did see, though, is that most major companies have pulled guidance for future quarters due to the uncertainty of the tariff situation. Along the lines of pulling forward guidance for earnings, we also saw a meaningful uptick in the word recession as it related to future business projections. It is becoming increasingly difficult for businesses to make meaningful decisions because of the rapidly changing trade policies that they are under. One economic statistic we are paying very close attention to is ocean bookings for freight that fell 49% in 1 week alone at the beginning of April. This was on par with COVID readings and with recent data of a drop of 64% in overall U.S. imports. We are bracing for shortages in goods to start showing up in June. This mix of a potential increase in inflation and slower economic growth has put the Fed in a very awkward and difficult place in terms of interest rate policy. Higher inflation would warrant an increase in interest rates, and slower growth would warrant a cut in interest rates. Clearly, they find themselves between a rock and a hard place, and we don't think they will move quickly until they see more significant signs of either a slowing economy or rising inflation. All in all, we are in a period of unprecedented uncertainty, which has made forecasting extremely difficult. As we move into the summer months, this will not abate as Congress takes up the renewal of the TCJA and potentially adds new tax cuts, which would be the largest tax cut in U.S. history if passed as proposed. We continue to question as an industry how this will be paid for, especially if you add additional spending, which is being proposed as well. All of this is coming at a time when our national debt and debt servicing costs are at historic proportions. We are paying close attention to how bond yields respond to this situation. Because of this uncertainty we are being presented with, we have shifted some of our U.S. equity exposure internationally, where we are seeing more stability and consistencies in policies. This has been reflected in their financial markets, and we are seeing meaningful governmental reforms happening that are also leading to renewed interest in their capital markets. We will continue to monitor this closely as we move through the end of the year. That is a wrap for the month, and please reach out to Ben or I if you have additional questions. Please look for our next market update with Ben and I on For What It's Worth in June, where we will take a deeper dive into the government's finances. Please be safe, and we'll see you next month.